I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, a man that manages and handles at least a couple of $1 billion in investments and money and capital. We're talking about Peter Schiff of Euro-Pacific Capital and Euro-Pacific Precious Metals, coming to us from Connecticut today. Peter Schiff, thank you for joining us on USAWatchdog.com.
Oh, sure, Greg. Thanks for having me on again.
You know, listen, I know when you're handling billions of dollars in investments in securities and capital and whatever you have up there, I know you're watching just about everything. And I want to start with the geopolitical situation, which in Russia looks like it's getting worse. I mean, they're delivering this humanitarian aid that the White House said would be unacceptable, and it just looks like it's getting worse by the day with the sanctions back and forth from U.S. to Russia, Russia now back to sanctioning Europe and the West on food. What is your view on how bad this could get with this situation? Let's start in the Ukraine.
Well, I agree with you that it is getting worse, and I have no idea how bad it could get. But I'm not really altering my investment strategy as a result of these events or any other events because I'm already prepared. What I'm trying to prepare my clients for is for the day when the dollar is no longer the reserve currency, a point of time in which the dollar surrenders a lot of the value that it currently has as a result of being the reserve currency. And so the interesting angle from an investor, forgetting about the humanitarian aspects about what might be going on there, but just from an investor's perspective, we're engaging Russia, not in another hot war, but in a financial cold war. And that simply, in my mind, just accelerates this process because I think that we're really unarmed, to have this battle because America depends on countries like Russia hoarding dollars, accumulating dollar reserves, and invoicing their customers in dollars and supplying Americans with products that we pay for with the dollars that we print. And to the extent that we anger countries like Russia, or maybe on a bigger scale, other countries that might be sympathetic with Russia's predicament and might be upset about the way we throw our weight around and might be upset that in holding dollars and perpetuating this dollar cycle, that they're really emboldening the United States to do this. And there are a lot of nations that might regret or resent, rather, the power that we wield, basically using their weapons. And so I think that all this, what's going on in Iraq, what's going on in Russia, Israel, and what's going on financially with the American government harassing foreign banks, fining foreign banks, enforcing FATCA, making all sorts of financial institutions outside the United States beholden to the United States, doing all this work, spending all this money to enforce our tax laws abroad. I think we're pissing off a lot of people that really we need to be sucking up to, and it's all accelerating this day of reckoning that I've been preparing for anyway.
A very interesting take. Nobody has kind of put it together that way. And I am worried about they're suppressing. There's been a lot of work. I know you're not in this camp, but people like Paul Craig Roberts, who's a former Assistant Treasury Secretary, has done a lot of work saying that, they're suppressing the price of precious metals. The debt's going up. Gold should be going up, but they're not. What say you about the price of gold? A lot of people are upset. They bought it $1,600 or $1,900, which it's not really a trade. It's what you're talking about. It's kind of a doomsday asset.
Yeah, there's not that many people, from my perspective, who just watched the price of gold go up from sub 300 and didn't buy any of it until it got to 16 or 1700. So I think the people that waited for 1700 to buy their first ounce, maybe they never really understood what was going on, and so they might be upset. The only thing that maybe I might be upset about, or some of my clients, is that we didn't sell when gold was way up there so we could buy it back now. But I've been buying gold and buying gold stocks, for a long time. I didn't wait until gold got to 1600, right? But I didn't sell any when it got there either, because I am preparing for a much bigger move. And sure, with the full benefit of hindsight, I could have traded my way into an even bigger gold position than I have now. And so some people might regret not having done that. But I do think that the main reason that the price of gold isn't much higher, it's not because it's being suppressed. And maybe it is to some extent, right? But I think it has more to do with financial ignorance. The fact that the vast majority of people who will eventually be buying gold, who should be buying it now, don't understand that they need to be buying it. Remember, these are the same clowns who were piling into the dot-com stocks at the height of the bubble, the same guys who were buying real estate and loading up on subprime mortgages. So there's not a lot of understanding among the financial elite, among the big players who manage trillions of dollars. And so they're making foolish investments based on a lack of understanding of what's happening. And I think when it dawns on a more significant minority of investors exactly the predicament the Fed is in, that this recovery in the U.S. is a mirage, right? That it is not real, and that rather than the Fed ending QE and raising rates, it's going to be launching a whole new round of QE, even bigger than the last one. When investors get their arms around that, they will be buying gold and they will be paying much, much higher prices. And then no one's going to be talking about manipulation because the price is going to be skyrocketing.
Well, when you look at the first quarter, which I was surprised it got revised down to 2.9%, and then we have this 4% number, and Paul Craig Roberts, very simply, he was on this, this week, and he very simply said, well, we went from, basically, we had a 7% swing up.
Well, remember, first of all,
the economy should be exploding, but it's not. Go ahead.
Well, first of all, they revised up that first quarter, so it's not minus 2.96 now.
It's 2.2.
Minus 2.1, something like that.
Yeah.
But the only reason we got 4%, or there's actually a couple of reasons we got 4% in Q2. One is because we didn't really get it. Remember, this is the estimate, the initial estimate. They're going to revise this number several times before they close the books on it. And my guess is that the revisions are going to be downward, which has been the pattern recently. Certainly since the financial crisis, the government overestimates and then revises down. And so when the initial headline number comes up, everybody celebrates. The revisions, are on the back burner. So, it doesn't get as much play as the first number. But if you actually look at those numbers, a lot of it had to do with an accumulation of inventory. And they've already started to downwardly revise those original estimates of inventory builds. So they're going to lower it down. I will be surprised, actually, if by the time they finish the second revision, if we're still even above 3. So I think we can end up in the 2s. We'll see. But what people also don't understand is that a lot of the bounce that we got in the early spring, right, April, May, that had to do with economic activity that didn't take place in January and February due to the cold weather. So many people are saying, hey, the reason we had minus 2.1 was because it was so cold, and so people couldn't shop or certain activity didn't take place because of the cold weather. Well, if you buy into that, that activity wasn't canceled. It was just postponed to the second quarter. So if you're going to blame the cold weather for the bad number in Q1, you have to also understand that that same cold weather is responsible for the better number in Q2. So what you really have to do to get a picture of where the U.S. economy is to average the 2 quarters, right? Because that's going to smooth out all the weather-related impact, right? And if you just look at the first half of the year and you average them together, you barely get 1% growth. Now, how could anybody call that a robust recovery, especially when at the end of last year they were looking for 3% in the first half? Instead, we got 1%. And you know what? I think it's all downhill from here. I think this the second quarter print that we just had, even though we're going to revise it down, I think that's the high print of the year. Even if they revise it down below 3, I think Q3 and Q4 are going to be bad. And I think that's when, at the end of the year, the Fed is going to have to acknowledge that once again, it's wrong. It overestimated the economic strength that is not there. And of course, rather than reassessing the wisdom of what they've been doing, right? Because it hasn't worked, right? They have diagnosed the economic patient. They come up with a cure of printing money, artificially low interest rates, QE. That cure doesn't work. In fact, that cure is the reason we're so sick, because it's not helping us, it's hurting us. But they are not going to acknowledge that. They're not going to figure this out. They're just going to prescribe more of the same. Yellen is going to say, We just need an even bigger dose. The patient was sicker than we thought. That's why it's not responding to our monetary medicine. So we need even more, right? We're going to get even more money printing. And again, it's not going to help. It's going to make the situation worse.
So you think by the time they start making these revisions on the second quarter here in the third quarter, you're saying that they're going to pour gas on a smoldering fire to get it stoked back up. What will happen to precious metals investments and things like that?
Well, that's when I think we really start to see some strength in the gold sector, because all the naysayers that have been betting on a strong recovery and a tighter Fed, they're going to have to throw in the towel. They're going to have to acknowledge that they were wrong. But, the interesting thing is, year to date, if you remember how bearish all of the experts were in December 2013, January 2014, about gold for this year, how everybody was writing the obituaries, all the Goldman Sachs, the Societe Generales, gold
700 an ounce, that kind of stuff.
Meanwhile, gold is doing a lot better than the stock market this year, and the best performing stocks are the gold stocks. And, they still have a long way to go. But even based on what they've done thus far, 2014 has been a good year for gold and an even better year for gold stocks. And it has not been a good year for the U.S. stock market, despite all of the fanfare with which we rang in the new year.
What do you think? The economy is going to be come December 31st? I mean, where do you think we're going to be with money printing, interest rates, the dollar, gold? Where do you think everything kind of comes together at the end?
As I said, I think the economic data is going to be weakening considerably into the end of the year, to the point where the Fed is going to be forced to admit that the economy is not as strong as it thought. Therefore, it needs more stimulus. It needs more help from the Fed. They can no longer continue with the taper. They're going to have to pause, or if they actually ended the QE. But remember, even if they end QE, it's not really over, because the Fed is always printing money and buying bonds, even if they're not doing it as part of an official QE program, because they're still reinvesting all the interest on their portfolio. They're still reinvesting all the maturities. Every time a bond matures, they don't actually ask the government for the money. They just loan it right back. So that is continuing. The Fed is not even talking about shrinking its balance sheet and asking the government to repay any of the money the Fed has loaned it, right? But I think that they're going to officially launch a new program. And because remember, going into 2015, it's going to be a very political year. They're going to start primaries. All the presidential candidates are going to start throwing their hats in the ring. And remember, Janet Yellen is the most liberal Fed chair we've ever had. The biggest Keynesianist, the biggest, liberal, socialist, whatever she is. No Republican president is going to reappoint her, right? So her only chance of having a second term is for a Democrat to be in the White House. And so she's got a lot of selfish vested interest in doing what she can to help the economy. And she believes that what helps the economy is printing money, right? She's wrong, right? She thinks helping government to grow is what's going to solve our problems, even though it's going to make those problems worse. So she's going to pull out the stops. I mean, it's going to be monetary pedal to the metal as far as Janet Yellen is concerned. So there's a lot more stimulus coming. All this talk of interest rates, when is the Fed going to raise rates? That's all going to be pushed aside. And meanwhile, the inflation, the official government measures of inflation that don't even come close to accurately measuring how bad it is, those official measures are going to get worse. So you're going to see the CPI well north of 2%, moving above 3%, 4%, and the Fed is not going to care. Yellen will do nothing about it. She may play a little lip service to it, but she's going to say it's temporary, it's transient, it's noise, it's good for us. She's going to come up with one excuse after another. But anybody who thinks Janet Yellen is going to do anything about inflation, that she's going to do anything to restrain it, doesn't understand Janet Yellen, right? She is going to create inflation. She sees it as a magical elixir, right, to cure what ails us. It's the snake oil that she's selling, but she doesn't think it's snake oil. And so when the market figures this out, the dollar is going to collapse. You're going to see a significant down move in dollar, and you're going to see a lot of people buying gold, not just, in the United States, but all around the world, because as we print money, that's going to put more pressure on the Europeans, on the Japanese, on the Chinese to print money. Eventually, they're going to come to their senses, and we're going to win the race to the bottom, right? We're going to win the currency war. But in the interim, there's going to be a lot of collateral damage. A lot of currencies are going to suffer, which means a lot of people are going to seek out refuge in gold and silver.
By the way you sound, it looks like you're saying gold and silver is just about bottoming out right here.
Well, I think we already bottomed out. I think so. I think we're already back on the upswing. So I do not believe that we're going to revisit the lows that we had. What was it? The end of last year, early this year. It's not impossible. I mean, it certainly could happen, but I wouldn't want to bet on it. I think that the trend is up, especially if you look at the now divergence. You see the gold mining sector leading now, and it was the miners that led on the way down. And so now they're leading on the way up. And I think gold stock investors are now starting to look forwards, and they're not quite as negative as they were on the future price of gold. But, I think there's a lot of buying coming. Not only I think are the speculators going to want back into the market, the ones that bailed out so abruptly in 2013, but there's a lot of shorts in this market. And, they got to buy. They got to cover before they lose too much money. And I still think that right now you still have a lot of mainstream experts who think they understand the gold market and who are convinced that gold's got no place to go but down. They're wrong. They just don't understand it yet. But at some point, it's not going to be about understanding it. They're not going to be able to take the pain. They're not going to be able to handle the losses as their positions move against them. And that's a very dangerous position to be in. Short gold, short silver, short mining stocks. I mean, there really is no limit to how high they can go. And if you've got a lot of leverage in these positions, there's a lot of money that a lot of people can lose. And so even if they don't understand why the market's going up, they're going to have to buy anyway just to mitigate their losses.
Peter Schiff, Euro Pacific Capital, Euro Pacific Precious Metals. Peter Schiff, great interview. What a great focus financially about what's going on and what's going on in the gold market, the financial markets. Janet Yellen, love it. Thank you so much for coming on and enlightening us on USAWatchdog.com.
Hey, anytime.